Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, January 21st, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. So the chart we're looking at is a weekly candlestick chart of the S&P 500 that goes back to the beginning of 2021. So I've got it set for January 1st of 2021. And a couple of lines here. We have the 40-week moving average. We have the 10-week moving average, this one here. But to start off with, let's talk about the performance. The S&P 500 was down 5.68% this week, and we closed at 4397.94. And that's this candle here. Okay, so each candlestick on this chart does represent 1 week of trading. Now, we're going to do a lot of analysis, and we're going to do this together, right? I'm going to do this in real time with you, so bear with me. This should be quite educational. Now, one of the first things I like to look at is the volume, and, at least, right, if there's anything good about this last week, is that the volume was lower, right? The downside volume was lower this week than the previous couple of weeks, and those weeks were lower than the two previous distribution weeks that we had back at the end of November and beginning kind of the second week here in December. So the fact that the volume is tapering off as the market comes down, that's something to at least embrace and be appreciative of, and maybe that tells us that this situation won't be a worst case scenario. But we're down below the 40-week moving average for the first time in quite a while. As a matter of fact, let's back this thing up, and let's go back 2 years to start off with, and let's see how far back we have to go to get to a point where we've traded below the 40-week moving average like we did this week. And that would take us back to, as you can see here, June of 2020. And this, of course, the blue line is that 40-week moving average, fairly equivalent to the 200-day, but not exact. So, the fact that we are, and it just shows you on a relative basis where we're at, but the fact that we're now below that 40-week moving average for the first time in over a year and a half, just shows that weakness, right? Now, we're also, and let's get back here, and we'll put this back to a 1 year for now. Kind of zoom back in here. And the other thing I like to look at is, let's bring up the annotation tool. Gives us some perspective here. And what I want to see is this 4,400 level, and we'll put it about right there. That'll get us really close. So that's right at 4,400. What this is going to show us is where we're at right now. Again, we closed just barely below 4,400. And so with this blue line, we can see that we're trading at levels that we first achieved on the S&P 500 back here in July of this past year, so July of 2021. And we can see there is, there's some trading around this area, right? So when you're doing this type of analysis, we want to see, what type of support we might have. Now, if we go down a little bit further, let's bring up that annotation tool again, get the horizontal line. And what I want to do is I want to drop a line around 4350, because we know that the 4350 level, and that is right at that 4350 area. We know that 4350 has acted, as we can see here, right here back at the beginning of October, end of September. We can see we pulled right down to that level. And then back in June is when we first got up to this 4350 level. And I have numerous videos, so I would encourage you to go out and look at some of my past videos, going clear back to this last summer, and you can see where I was talking about this 4350 level that acted as overhead resistance right here, and then acted as support at the end of September and and then beginning of October. So again, you can go out and fact check me if you so desire, and it's quite educational if you want to learn more about technical analysis and how to do some of this stuff yourself, how to think about the markets. But again, if you want to fact check me, please, go back to June, July, August, September, October, and check out these videos where I talked about this 4350 level and how important that has been. So hopefully, right, we'll find some support around this 4350 level. So, one of the things that I'm doing here, and hopefully you can see that, is that I'm looking at possible downside targets and where we might find some support. Since, we did break below that 40-week or 200-day moving average, they're going to be pretty equivalent. Sometimes the market will stop right there. Well, obviously we sliced right through it. So if we're going to continue to fall at least a little bit more, 4350 would be really the first downside target where we might find some support. So hopefully, right, that will kick in here. Not a tremendous amount of support, but it was there for several months this last year. So that would be a logical place to look at. The next logical support area where we do see quite a bit of trading is going to be around 4,200. And that's right in here or slightly below. So, 4175, as you can see here, I've got the line kind of right there. And, let's put this line at 4200 to give us something to work with. And then we'll draw a box, kind of a rectangle around this area, kind of encompassing 4150 to, let's see, I'm trying to eyeball this, 4150 to about 4250. So hopefully you can see what I'm doing there. And save those changes. All right. So if we look here, and again, these are the levels of the S&P 500 over here. So the this blue line here, I just drew at 4200. And you can see the rectangle I drew around this area, which goes clear back to April, May, and June. And you can see that prior to getting up to the 4350 level right there, we had traded for about 2.5 months, almost 3 months, a little over about 2.5 months in the 4150 to 4250 level. Let's call it 4200 plus or minus. So again, as we're doing this analysis, as we're trying to find potential downside targets, as we're trying to find potential support areas below where the S&P 500 is currently trading, and even if you're not 100% invested in the S&P 500, this is extremely valuable information, guys, because if we can get some downside targets for the S&P 500, keeping in mind that 90+% of all stocks over time will go in the same general direction as the S&P 500, maybe not exactly at the same time, but they will go in the same general direction. If we can get some idea as to potentially how much further we may have to go on the S&P 500, and it could be a lot more, guys. We don't know, right? Especially with has as ugly as the trading was this past week, and if we get into a negative feedback loop, as I call it, and I've seen this go back to 2003 when I was working for Oppenheimer Funds, I lived through that, and then the 07 through 09 bear market. If we get into a situation like that, it just, bad news is bad news and good news is ignored. And, it just, especially in the 2000 through 03 bear market, lasted multiple years. It just seemed like every time we were starting to pull out of the downturn, something else would happen. So, and if we get into a market like that, guys, we could continue to go lower. All right. So let's keep going here. But 4350, obviously the first potential stopping place. And then we do have a thick area right here, right, where we traded for over about 2.5 months or so around this 4150 to 4250 level, and that would get us to 4200 plus or minus, right? So if 4350 doesn't hold, then 4200 plus or minus would be another area. And again, this could help you set stops or whatever on some of your investments. So this would be another area to watch. Now, let's back this chart up, and let's go back to 3 years this time, and let's see what we can find here. And the next thing I want to do here, well, All right, let's keep going with this type of analysis for a second here, but I have one more thing, obviously, I want to get in that's super important, scary, right, because of the potential downside, but it's super important. So let's look at, let's just kind of use this line, and let's keep this one moving, and I'll talk you through it. But so if the 4,200 level doesn't hold, you can see there's quite a bit of trading around 3,900, right? A little bit at 4,000, but man, not much. We'd really have to get down to this 3,900 level, as you can see where this blue line is. And I'm going to stop it here and just kind of circle it, right? And you can see there was some trading around that. If that level doesn't hold, then really when we start to get into a thicker area down around 3,500, and you can see where 3,500 right here where my cursor is moving over this blue line acted as overhead resistance back in 2020, August, September, October, and then finally we broke above that in November. So that's 3,500. And really, that's one of the stronger support areas on the S&P 500 below where we're currently trading. So hopefully you can see that, but 4,350, 4,200, again, maybe some support around, around 3,800 to 3,900. You can see there's kind of some trading right in here, right around this area here. 3,500 becomes even a better floor. But oftentimes when we get into these types of pullbacks, I've seen this time and time again, guys, where if the market rolls over, it will oftentimes check back to the peak of the prior top before we rolled over, all right? So if that's the case, and that would be a pretty uncomfortable pullback, but that would bring us down to around 3,400 right in here where we peaked in February of 2020 before the COVID sell-off, all right? So that's not that much lower than this 3,500 level that I was talking about, all right? Now, I want to be very clear here. I'm walking you through doing technical analysis and looking at where support and resistance areas are below where we're currently trading. So if the market does continue to sell off, we know where some potential downside targets lie. I am not making predictions here, guys. I don't make predictions. I cannot predict the future. Neither can nor can anybody else. So, people can, throw themselves out there, and more power to them, I guess. But I think that's super dangerous, right? I think the best thing to do as a technical analyst is approach the market in an if this then that scenario, all right? And I learned this from reading that if this then that. I learned this from a lady named Tony Turner, who's written several books. She's a well-known trader around Wall Street, and in reading her books years ago, I picked up on that if this then that verbiage, and it just makes sense to me, right? So if this happens, then this happens, then this might happen. So if we break below 4,350, then 4,200 is the next downside area we want to look at. If 4,200 doesn't hold, then we probably will find ourselves somewhere down in the 3,800 to 39 range. If 3,800 to 3,900 doesn't hold, 3,500 would be the next logical stopping place because of this thick area here. If we're going to retrace down to the top of the prior peak, right, which would bring us down to an even thicker area, that would get us down to right around 3,400, maybe a little bit lower, maybe down around 3,300. So somewhere in this, 3,400 plus or minus 100-point area would be, it would be a really uncomfortable pullback, but we might find ourselves down there, right, in a very serious pullback, guys. We'd be naive to think it couldn't happen. Now, let me get rid of this line here, and let's go to another thing I like to do, which is Fibonacci retracements. Now, these things, guys, I could live 3 lifetimes and spend all of my time in the next 3 lifetimes doing Fibonacci work because it's so fascinating, and there's so much to learn from it. And this shows up in seashells and galaxies and everywhere. As a matter of fact, what I'm going to do is I'm going to erase all of my drawings so that we can have a clean slate to work from. Now, if you're familiar at all with Fibonacci work, there's some key levels, 61.8 and 38.2, but also 50% shows up not as a true Fibonacci number, but in technical analysis, a 50% retracement is a fairly common retracement of a prior move. So let's see, based on what we just did, let's see where some of these Fibonacci retracements may line up based on what I just told you. Okay, so what I've done, and I've lined up the lower end of the Fibonacci line down at the lower part of the tail of the candle, right, that goes clear back to, again, these are weekly candles, that goes clear back to the COVID low in March of 2020, and I have put the peak, right, I've lined up this top Fibonacci line at the peak of the market 3 weeks ago, all right? So, and this will at least get us close, but it's amazing, guys, how accurate this stuff is can be over time. So a 38.2% retracement of the prior move, right? So the whole move so far has been from March of 2020 to where we peaked 3 weeks ago. So if this was indeed the peak, and if we are going to roll over, a 38.2% retracement of this entire move would take us down to 38.1626. Let's just call it 38.20. But remember, I said 3,800, right? 3,800 plus or minus. Well, that's close enough. All right. So that takes us down to this 3,800 level I was telling you about, right? Plus or minus. So it's right in line with some of the numbers that we talked about. If we're going to see a 50% retracement of this entire move, right? That would take us down to 3506.63, 3,500, close enough. That's where I drew that horizontal line. You can see there's some support there. And if we're going to see a 61.8% retracement of the entire move, that would take us down to right around 3,200, 3,197, all right? And that would be right in here, and you can see there's quite a bit of support and trading right through that area. So again, that gets us anywhere below 50% retracement. A 50% retracement, somewhere between 61.8 and 50% retracement of this entire move from March of 2000 to current, right, 3 weeks ago. That gets us down into this area here, which is that 3,400 plus or minus level, and takes us down to the peak of where we were in February of 2020 prior to the COVID downturn. So that gives us some potential downside targets, guys, using technical analysis. It's uncomfortable. You know, there are some well-known. Jeremy Grantham is who I'm thinking of. This guy's a legend. He's a value investor. He's made some bold calls. You know, and again, when you make predictions, man, you're throwing yourself out there, and you're not always right. And remember, I am doing analysis and looking at potential downside targets. I am not trying to suggest that I'm not making predictions as to these levels where we, you know, would go. But it does make sense, right? The more you understand Fibonacci retracements, the more you understand support and resistance levels, you know, if we continue to see a pullback here, you know, it makes sense that we would pull down to the 3,800 level. It makes sense that we would pull down to 3,500 or even below, because that's where a lot of the support is, and that's where, you know, the Fibonacci lines line up, and that's where this, you know, roughly 3,400, right over where my cursor is circling, just left of center. That's the prior peak in the stock market before we rolled over. And oftentimes, when you get these pullbacks, you pull back to the prior peak. So hopefully, guys, it won't get that bad. But to think that it couldn't, I think, would be naive on our part. Okay? So these appear to be some dangerous markets. Hopefully, right, this, you know, 34, let me try that again. Hopefully, the 4350 level that we talked about first, that has been a support and resistance level in the S&P 500 since June of this past year. And I would go back and look at some of my previous videos if you want. But hopefully 4350 will hold in, and if that doesn't hold, maybe, you know, 4200. Maybe we'll get lucky in 4200 plus or minus. But if we break below 4,000, guys, then, you know, or even 4,100, then it makes sense that we're going to find ourselves probably somewhere around 3,800, and if that doesn't hold, then 3,500 or even as low as 3,200 or 3,250, okay? Hopefully Jeremy Grantham, and I'm not sure if I finished my thought on that, so I apologize, but Grantham is saying we could go as low as 2,500. You know, if we get into a really bad bear market, a 50% retracement of the, you know, of the stock market, you know, losing 40, 50, 60%, as we did in 2000 through 03 and 07 through 09, it's completely possible, right? The math is there. If we have contracting multiples, right? So PE compression, contraction, as well as earnings falling. So if earnings continue to, if we start to see more and more companies, right, that where their earnings are contracting and we get contracting multiples, that's where I guess we could find ourselves down into this area around 2,500 that Grantham is talking about. I right now, that doesn't look very likely. The more likely scenario is the things we've already talked about here. But, to think that that's not possible, again, would be naive on our part based on historical evidence where the market can lose in a really bad bear market. We can lose 40, 50, 60%, in a really bad drawdown. So is that possible? Yes, it is completely possible. At this point, I don't think it's very probable, okay? So I hope you guys have enjoyed that. Please pay attention to the rest of the video because I have some more super important information to share with you. Also, don't forget to subscribe to this channel so you don't miss any important videos from me in the future. Do you have exposure to the S&P 500 or other large cap U.S. equities? Have you ever felt out of sync with the stock market? Would you like the opportunity to increase your upside capture, decrease your downside capture, improve your risk-return profile, and have the ability to sidestep major market downturns? If you said yes to any of those questions, the next thing you need to do is watch the How to Be More Successful in the Stock Market video that is on this YouTube channel. I will also leave a link to that video in the description box below the video you are currently watching. Would you like the advantage of knowing when it's generally safest and most profitable to be in equities, and when it's most dangerous and generally least profitable to be in equities? If you said yes to any of those questions, the next thing you need to do is watch the How to Be More Successful in the Stock Market video that is on this YouTube channel. I will also leave a link to that video in the description box below the video you are currently watching. Want more charts? Want access to proprietary market information? Want to minimize the likelihood you will experience catastrophic losses in the market? If you said yes to any of those questions, the next thing you need to do is watch the How to Be More Successful in the Stock Market video that is on this YouTube channel. I will also leave a link to that video in the description box below the video you are currently watching. This can make a huge difference in your life going forward.